What is the hottest sector in middle market M&A? Is private equity starting to get more active? How is the 2025 outlook for middle market deal making shaping up? Here are the answers to those questions and more on the next edition of the Pipeline Podcast. Welcome to the Pipeline, an S&P Global Market Intelligence podcast where we talk about all things M&A and IPOs. I'm Joe Mantone, your host, and on this edition, we speak with
Michael Mufson, and I'm managing director and co-founder of the Philadelphia-based Mufson Howe Hunter and Company. We're a broker-dealer investment bank in Center City, Philadelphia.
Michael's investment banking firm focuses on the middle market. Many of the deals his firm works on involves private equity. The absence of private equity has been a big reason for the downturn in M&A that started in 2022, but Michael sees that changing. The amount of dry powder in PE coffers, along with the number of portfolio companies that PE needs to liquidate, should serve as a catalyst for M&A, Michael said. But through the first half of 2024, M&A volumes have remained largely muted, especially in the middle market. I started off asking Michael about that. Here's our conversation. Looking at some of the overall M&A activity numbers, and it seems that some big deals have started to come back to the market, say $10 billion and up, but the number of transactions overall has still been kind of muted. Um, why do you think that is the case?
Well, it's interesting, the stats for the first 6 months, I think the mega deals or the billion-dollar plus market been off about 15% year over year, where the middle markets, which is where we play, and we define the middle markets as roughly half a billion and below, and even 250 and below. But the larger transactions, there's just so much liquidity out there. There's so much so-called dry powder in the private equity world, the bulge brackets, the KKRs and the Apollos, that ilk. It needs to put out money. There's the credit markets, the private credit markets are filled with a lot of liquidity. And so they're trolling. They need to put money out. And I think that's really, and rates have stabilized and are likely to come down. So there's more certainty in the credit market. So the confluence of that is causing, larger deals to occur. And we're starting to see the middle markets picking up a little bit. We, in the last couple of weeks, have been seeing a lot more activity. But I think the reason it's been sluggish is really all about rates and the economy. A lot of companies have just been reporting lackluster growth, and that has caused a problem coupled with a higher rate environment. I think investors are a little skittish, but I think that's changing a little bit. And we're starting to see that our bid activity is picking up.
So you're seeing some more dialogue amongst clients?
Yes, we are. We are. And so our firm is a middle market sell side M&A firm, and we primarily work with what we call first to market companies, multi-generational family businesses, closely held companies. And we are the bank to the baby boomers. These are people that started businesses and now are in their late 50s or to 75 plus, and they need a liquidity event. And that's kind of our market. And private equity is the group to give them that event. And they refer to as recapitalizations, where our clients will roll over anywhere from 20 to 30% of new co, and private equity will own about 70% or 80%. And that recap is really what is giving these baby boomer business owners the liquidity they need for retirement and for family planning.
Sure. And you mentioned that interest rates are still the biggest sticking point. Are there any sort of creative deal structures that can sort of get around that and help bring the buyers and sellers together?
Well, we're seeing more earnouts in deals. We're seeing more bigger rollovers. So I think taking down and valuations are down. So what's really kept people back when the credit markets are a little unstable, buyers aren't bidding aggressively. So once the credit markets stabilize and creditors are coming out with higher leverage multiples, it allows valuations to go up. So typically it's a 50-50 split between debt equity. Actually, equity is a little higher right now than debt is a percentage of funding composition. So if you can, a lot of people were holding up in our world because they're thinking of 2021 multiples. They wanted 11, 12 times when the market is now 8, 9. And I'm using those as just pull downs as an example. But when you're starting to see 4, 4.5 leverage multiples, you can get to 9 and 10 valuations of EBITDA. So people are coming back out again. The market's good. And I think the holdup was valuations were just not that exciting to some sellers.
I know a lot of the companies that you deal with are private companies,
Mhm.
but we have seen a run up in smaller cap stocks lately,
Yeah.
recently. I mean, does that? I'm sure that helps. Got to help the valuations of your clients
You
a bit,
know,
right?
it does. Clearly, public valuations are always give comfort because a lot of investors will say, "All right, I'm coming in, and I'll probably want to grow." They'll want to buy a platform from an investment bank like ours, and then grow it, and then eventually sell it to one of the large public companies or a much larger private equity group. But yeah, they want to see that they're the public multiples are usually a third, 30% or so higher than what they're going to pay on their end. So yes, when the markets rise, the old adage of a high tide raises all boats. There's a little bit of that going on here.
Okay. And then kind of getting back to interest rates a bit. Obviously, we're expecting to see a Fed rate cut coming up
Yep.
pretty soon. How much do you think the Fed needs to cut rates? It would just one cut by itself be enough to sort of spur more M&A?
Yes. Yes. I mean, it's kind of baked in right now that rates will be coming down. But I think the fact that rates aren't going any higher is a big benefit right now. So clearly, whether it's two 25 basis point kind of drops or whatever they do, it's the backdrop is that rates are coming down a little bit. I think it's just a certainty in the markets that it's stable and likely to drop a little bit, which is getting people a lot more comfortable about. And coupled with there's just so much private capital in the private credit markets. We're not the commercial banks aren't the ones that are really active here. It's really the credit markets, the so-called turnkey unitranche lenders that are doing a lot of the activity with private equity. So, but there's again a lot of credit in the market to put out, a lot of liquidity that people are taking advantage of.
And the commercial banks not being involved, is that a change in the marketplace?
I think so. It used to be 5, 6 years ago, it was your local big bank was the one who was providing the leverage in a middle market deal. I think it's the majority of them are private credit funds that are doing this right now. They're offering a lot more flexibility. They're offering higher leverage, and some of the layering of the debt is a little more creative, which commercial banks just can't compete with.
Interesting. So it has that private credit and also what you mentioned earlier about sort of the rate cuts being baked in. Is that kinda the driver behind some of the increased dialogue that you're seeing?
Yeah, yeah. I think it's the credit driving valuations up, people getting a little more aggressive to bid. It's the dry powder that's sitting in all the PE sponsors, and it's a whole infra that is starting to turn. LPs want capital back, so there's a lot of companies that are in private equity portfolio need to be sold to get back capital to the LPs so they can raise additional funds. So you've got a lot going on right now. There are a lot of private equity sponsors needing to sell portfolio companies that have been in their possession for 5, 6, 7 years that need to come out. And there's a lot of new companies that are in need of liquidity. So I don't want to say it's not a feeding frenzy, but certainly the dynamics would appear that, and then the variables in the market with all the cash in private equity, the credit markets having tremendous liquidity, you would think, and clients of ours needing to sell businesses for various reasons, and private equity needing to sell a little long in the tooth portfolio companies because the markets are getting a little more robust. It would appear like the perfect storm is coming ahead.
And I kind of wanted to ask you about sectors a little bit.
Yeah.
One sector that I noticed where we've seen some activity has been the industrial space. You have any thoughts on what's been sort of driving the activity there?
I think well, we're seeing a lot of infrastructure related activity. So in manufacturing, we're seeing building products, even steel distribution. In the building products area, a lot of curtain wall, a lot of things are going into commercial buildings, multi tenant, which is, steel seems to be an area now that there's some strategic interest. And we're in the metal services center area. We're seeing a lot of construction services right now, electrical, mechanical, civil. So that seems to be kind of heating up, and their backlogs are quite large. Many of them are over 2-year backlogs. So there seem to be a great time for them to dip their toe into the market, and we're seeing that.
And why is that the case?
I think it's the infrastructure bill. There's a lot of building that's going to be taking place. Money's starting to trickle in, and yeah, there's a lot of demand for product, and it just kind of works its way down through the channel, the supply chain.
Interesting. So how about the commercial real estate? Obviously, we've heard there's a lot of headwinds in the commercial real estate space. Does that play a role at all in the
We don't do real estate here, so I can't comment. But we're seeing demand from building product companies. Somebody's buying these products. So whether it's latent from things that were built that started up in 2021, 22, were on the plans and now they're being implemented. It seems a little counterintuitive because the real estate markets seem a little slow, but we're just seeing in the construction world, there's a lot of industrial. Obviously, you're seeing data centers being built around the country. That's helping a lot of the electrical. There's technology. We're building these massive semiconductor fabs. That's causing a lot of activity. So it's in many sectors.
yeah,
Construction
data center?
trades are crazy busy right now in the commercial end.
Any other sectors that you see picking up middle market deal making
A
standpoint?
little bit in the consumer space. That got clobbered in early 2023, where we started seeing the consumer spending drying up a little bit. And a lot of the product companies were restocking and they stopped ordering. So it's hurt a lot of people. So but that market seems to be coming back a little bit. Maybe towards the end of the year, some of the consumer product companies will be pre COVID again. But the activity we're seeing, for whatever reason, tends to be a lot in building products and construction services.
Yeah, it's interesting about consumer. One thing I've been thinking about is whether we could kind of look at middle market M&A as sort of a bellwether for the economy. Do you think that M&A activity in this space could be a sign that better economic times are ahead or more challenging times are ahead?
I think the market, it goes, I wish they had that long term view of it. I think the moment is kind of right. And if I know my stats a little bit, there's probably 7 or 8 thousand companies that are sitting in private equity portfolios that need to be kind of liquidated over the next couple of years. So, and then you have almost $1 trillion in dry powder in the market. And if you assume an average $200 million deal and 50% of it's going to be funded with debt, you can do the arithmetic. I don't know, that 10,000 companies so need to be invested. And I just think it's money looking for a place to go. And I think the stars and planets are going to be aligned. And you'll have moments in time where, as long as rates and inflation are kind of under control, I think you're going to have a very, very active market. So, yes, I do think the middle market is so diverse in industry sectors that it is a good bellwether indicator for the economy. And I would say, I believe the economy is going just from those factors will be good to very good. and we have an election coming up. Don't see the election affecting the market terribly. We're not hearing that from investors. We're not hearing that from lenders, which is surprising because we've been asked that question a lot. And I just think it's the factors here are just so big that we're going to see a good to very good M&A market for middle market companies, certainly through 2025.
Yeah, the interesting point on the election. I feel like there's always two different takes on that. Some people say that it's going to push deal making to the sidelines, while others just say it's not doesn't really have that much of an effect.
I guess still taxation, that will drive a few things. So if one party gets the House, the Senate, and the White House, then come back and talk to me. It might be different depending on who it is, but we're not hearing people talking about taxation yet. We had that a couple elections ago where there was talk about capital gains increases at one point in time. And then there was another time where capital gains were dropping. And that's, fueled a lot of activity. I can't recall my dates on that, but that we were busy towards year end was a while ago. But yeah, I don't see from what I'm reading and that the election is going to affect much in the near term.
Gotcha. Okay. Well, those are all really good points, and I appreciate you taking this time with us today,
Yeah,
Michael.
yeah, my pleasure. I love talking about my craft. I've been doing it for a long time. So anytime, I appreciate you inviting me on.
Well, that'll do it for this edition of the Pipeline Podcast. We thank Michael and we thank you for listening.